Hello, everyone, and welcome to this week's special edition of both Bondcast and Currency Exchange. Normally, we have two separate podcasts focusing on interest rate markets and foreign exchange markets, but today we're joining the two together really to talk about specifically U.S. tariffs, the decision on Friday, the Supreme Court overruling the IEEPA tariff authority, the president's very quick transition of tariff regimes, the impact or the lack of impact on FX markets and also on U.S. rate markets. And to talk about all of that, I'm very happy to be joined by Ian Vanderhorn, who covers U.S. rate strategy for us here in the U.S. Ian, thanks so much for joining.
Thank you so much for having me, Brian. And yeah, like you said, I think given the ruling on Friday, it makes sense to have this be a tariff-focused episode. So if you can, why don't you walk us through that Supreme Court decision on Friday and really what it means for markets going forward?
Sure. So just as a reminder, the president has a number of different authorities under which he can impose tariffs. There are other authorities. We can touch on those in a second. But one option that he has to regulate importation is the IEEPA, the International Emergency Economic Powers Act. And this statute basically says that under a national emergency, the president can do a lot of specific things to correct that national emergency. Sanctions are one of those things. Embargo is one of those things, limiting trade. But it doesn't specifically cover tariffs, which tariffs are a revenue-raising piece of trade policy. And raising revenues, the power of the purse really falls back to Congress. And so that's a core power of Congress rather than the president to raise revenues. And so early in 2025, the president took a bold step to try and authorize tariffs under this statute that's much more commonly used for sanctions policy, and to do so very quickly. The benefit for the president of that action was that using the IEEPA authority allowed the president to move a lot faster because these tariffs were taken under a national emergency. A lot of the behind the scenes background work, the sort of checks and balances on tariff authority that are included in a number of other tariff statutes that Congress has explicitly provided to the president, a lot of those fall away, and the president was able to act extremely quickly. And we saw a number of examples of that throughout the course of 2025. So when this was challenged in court, the specific question was not whether the president has the authority to impose tariffs at all. It was, does the president have the authority to charge tariffs under this specific law, this emergency powers law, which gives the president a lot of power in a national emergency, but not specifically the power to impose tariffs. And so what the Supreme Court decided was that the IEEPA tariffs are not legal, that the president overstepped his bounds when using this specific law to justify tariffs. But other tariff authorities were not challenged under this rule. That includes tariffs that were not in effect before the ruling and have since come into effect. So the tariffs that were invalidated include the entirety of the reciprocal tariff regime, the Liberation Day tariff rollout. That entire regime was justified under IEEPA. Those have now been removed but replaced. We'll talk about the replacement in just a second. Additionally, some of the national security and trafficking linked tariffs were also IEEPA justified, and those have been nullified as well. So you think about tariffs on Canada, Mexico, China related to fentanyl and illegal drug trafficking. Those have been invalidated by the IEEPA ruling. And additionally, some of the national security tariffs related to, say, India purchases of Russian oil, which was a tariff that I believe has since gone away because of the deal with India, but something that was proposed, that is something that's invalidated here. And also additional tariffs on Brazil over their treatment of former President Bolsonaro. So all of those tariffs have since been invalidated. But what the president made very clear in our view throughout all of this was that the president has a lot of authority outside of IEEPA to impose tariffs, because trade policy is this weird intersection between powers, right? Because the president is the one who controls international relations. They're the ones who do the negotiating on behalf of Congress. Imagine the nightmare it would be if every single member of Congress had to go to every country on earth to negotiate trade policy, right? So the president has foreign policy authority, but not taxing and tariffing authority that goes with Congress. So Congress over time has given the president more leeway to act and use tariffs under specific options, specific laws. IEEPA being not one of those laws, and that's something that the Supreme Court confirmed on Friday. So the president always has a number of options, fallback options, to transition the tariff regime, and that's exactly what we got on Friday. One of those options was untested, which was Section 122 authority, which allows the president to impose an up to 15% global minimum tariff, or global tariff, I should say, in response to a balance of payments crisis. So the interpretation from the president here is that because we have a global trade deficit, and we have for a very long time, then we have justification for global tariffs of up to 15%. Under Section 122, the tariffs imposed are temporary in nature. They require congressional approval. So here's an example of tariff authority that Congress gave that was more limited compared to IEEPA, which is similar level of tariff authority. The president can do tariffs, but Congress has more clear of a say in these tariffs. So after 150 days, which puts the tariff expiration in the end of July, Congress would have to give an up-down vote over whether or not these tariffs stay in place. My assumption here is that Congress would not approve the new tariffs. They've already really struggled with their narrow majorities and that the Republicans have to justify tariffs in Congress. Additionally, I think behind the scenes, a lot of Republicans are wary about the tariffs. And so it seems unlikely to me that those would be extended beyond that 150 days. So we've replaced the IEEPA regime, which frankly in most of major trading partners had sort of found its way to a 15% tariff, with a new regime in which everyone faces a 15% tariff with similar exclusions to what we had under the IEEPA regime that was ruled out. So what happens after the 150 days? We think the administration, and we can confirm because they've told us, they are going to be working very hard behind the scenes to transition the remaining tariffs into something more permanent than the 150 days under the Section 122. Specifically, Section 301 authority, this is something that should be very familiar if you followed the Trump-China trade war from the first term. The entirety of the U.S.-China trade war in term 1, Trump 1.0, 2018 and 2019, was effectively justified under Section 301 authority. So what that Section 301 allows is the government has to make a case to Congress. They write a big report identifying a problem. And then once they've identified that problem, the president has the authority to take remedial action in the form of tariffs and other potential options. But the difference between that and IEEPA is they have to actually go through the legwork. They have to do the work to justify the tariffs, which did not exist under IEEPA. Under IEEPA, you say there's a national emergency, and because of the emergency, I have broad sweeping powers. Of course, now tariffs no longer allowable under that interpretation. So we think over this 150-day period, the USTR and the Commerce Department are going to be extremely busy, writing as many Section 301 reports as possible to justify returning tariffs to the levels that they were before Friday's decision. So I think the net result of all of this uncertainty is that the tariff regime that we had on Thursday is going to end up looking very similar to the tariff regime that we have at the end of this process. Right now, we have a temporary 15% tariff, and that countries that faced other IEEPA tariffs, say Brazil, for example, are relatively a winner in the short term. But over the more medium term, I think foreign negotiators, and I think it's clear the market also seems to agree that the long-term steady state for tariffs really hasn't changed all that much because the president has those authorities to transition the tariffs. And I think we really see that in the market reaction. So Ian, I do want to bring you in here because in the rates market, I feel like especially, maybe more so than in the FX market, there was a big focus placed not just on the future tariff revenue, what's the next step for tariff reimplementation if the IEEPA tariffs were overturned, but also on the issue of refunds, because the Supreme Court's decision didn't really give us an indication one way or the other about the treatment of previously collected tariffs. And they basically said, hey, we'll leave that to the lower courts to decide. And if you go back to the CIT, the Court for International Trade, they had originally mandated that we should have tariff refunds. And so, my interpretation of that would be that we will have tariff refunds. How are you incorporating this into your expectations around debt and deficits? Is this something that we should be worried about in terms of a material shortfall in revenues for Treasury?
The short answer to that question, in my view, is no. But before I dive into the refund side, I just want to mention, or I guess emphasize, one of the conclusions that you came to with respect to the IEPA ruling. You mentioned Congress's power of the purse as one of the justifications for striking it down. But I also find it interesting as you discuss Section 301, Section 122, which is now implemented, and Section 232, is that really the other takeaway that I took from this ruling is that IEPA is simply just not the avenue for tariffs specifically. You mentioned that it was the avenue for other type of trade coercion. But I sort of emphasize this point because indirectly they also came off, certainly in President Trump's eyes, as sanctioning the other methods that you've since mentioned to do 122, Section 122, Section 301. Not a direct sanctioning of these other acts, but certainly indirectly. And I think that will be important because we're already hearing chatter, at least in our neck of the woods, about lawsuits against Section 122 and when those might be taken up by certain people. So I just want to highlight that point. Like I said, you came to it, but it is a more difficult, I guess, rebuttal to the temporary tariff regime that we see today, just because of the nature of that Supreme Court ruling against IEPA. Now we'll bring it over to refunds because, like you said, that really was the focus, at least on the rates side, with respect to this outcome. The big question being, will Treasury need to refund the tariff revenue that they've already collected back to the importers who paid it? So as you said, the Supreme Court really didn't rule on this. They kicked it back to the lower courts, and the lower courts already ruled that it should be paid. So I think we're going to see additional litigation here back within those lower courts, and it could be drawn out, it could be very messy, and it could take a very long time. So to your question, I think the important part for us is that it's unlikely that Treasury will need to return, billions and billions of dollars in the near term and cause this sort of emergency for the Treasury that I think some in markets were expecting. If we think about the actual numbers, they are very significant. I think under IEPA, revenue collected was, some estimates have, over $170 billion. That's about 60% of the post-Liberation Day tariffs, if that is the right number. So as you said, if we can interpret this as the lower courts again ruling that this needs to get paid back, but it happening over a very long time, we could be looking at this 170 billion going out of Treasury's coffers over, certainly months, but also potentially years. So that brings my focus, I think, to the near-term impact. And I think the fact that there's no lag or disruption in terms of implementing Section 122 and IEPA ending is important here, because IEPA fell away at Tuesday at midnight, and that's just when Section 122 went into place. So there's no overlap between the IEPA regime and this 150-day Section 122 regime, which, as you mentioned, is a 10% global tariff. But that 10% is also set to increase to 15%, and that should happen relatively soon. And if I just think about what that'll mean for the effective U.S. tariff rate, if we get that 15% in place in relatively short order, the impact to the effective rate is going to be negligible. I've seen some estimates which align with our own internally here that it would be less than 1% impact to the effective tariff rate. And you went into great detail about how over those 150 days, the administration would be working to implement a new regime that would match that of IEPA. So if we have this temporary sort of bridge that is going to get us to the same effective tariff rate, and then in the background, we're going to be working on Section 301 justification to reach there in the longer term past 150 days, I just don't really see the justification yet to alter, our longer term expectations for funding, or even really our near term expectations for funding. I will mention though that the snap reaction in markets on Friday was that the long end of the Treasury curve came under a little bit of pressure. And I think it's fair to say that that was the market perceiving that there could be a longer term impact to the deficit. If I just think about our own deficit forecast, we're counting on, about 30 billion per month in tariff revenue, or, close to 400 billion per year in tariff revenue as being the meaningful offset to President Trump's one big beautiful bill tax cuts. And if we don't get that, we'll see, potentially see the deficit increase by that 400 billion. But as I mentioned, that's just not the expectation yet. So yeah, I think the snap reaction was pressure on the long end of the curve. I think that's right that it's since been mostly faded. I know there's a lot of reasons for that. We have, tension in Iran. We have some jitters in stock markets related to AI. But as you said, markets just really aren't counting on this being the massive game changer that some had expected because of the 122 implementation relatively immediately, and because of the Section 301 justification that can be used to rebuild it. So like I said, really little change to our long-term funding impact here, and also no change to our near-term funding expectation as it regards bill issuance, et cetera, et cetera. But I'll just, I guess, flip back to you, because that was the market reaction in rates, but also somewhat of a muted reaction in FX markets as well. So what was your interpretation from the dollar move?
Yeah, so from the dollar side, very similar, where the snap reaction looked sort of favored a weaker dollar on the initial interpretation. And I think that's interesting because I think you could argue that if the market assumed that maybe there was going to be a loss of tariff revenue and maybe a change in tariffs, like, okay, tariffs are going away, you could probably argue two sides of that coin, which is it's either a positive for non-dollar currencies because it's a bigger kicker for external growth, it reduces downside risk to growth externally. But of course, that requires that tariff relief to actually occur, which it really didn't, because just how quickly the new tariff regime came in. The other side of that coin is if you were to, take away the IEEPA tariffs, you could maybe create some sense of institutional credibility that maybe leans against a kind of sell America narrative around tariff and tariff escalation. So, you think about the one thing that IEEPA tariffs really let Trump do was change things extremely quickly. His ability to change things very quickly is going to still be there, but the odds of a Liberation Day Part 2 may in theory go down if Trump is unable to use IEEPA and instead has to use these more onerous authorities that require a bit more legwork. So I think you could have reasonably argued both sides of the coin in terms of the dollar reaction. But, as we look, you mentioned a couple of the more near-term drivers, some recent concerns around AI, specifically in U.S. equity markets, greater focus on geopolitical tensions. Also, as we look ahead, we're coming up on the turn of the month here. Early March is just around the corner. Certainly doesn't feel like it with how cold and snowy it's been here in the New York region. But we're also going to get some of the February data coming out, some of the top line February data coming out, with, I think, still all eyes on that non-farm payroll report we will get next Friday. Given just how strong the January numbers were released in early February, some question over whether or not, hey, are we going to see an extension of that bounce back in early 2026 data, or is the February number going to look a little bit less strong, maybe suggesting that the trend hasn't improved as much as that number would have you suspect. And so the dollar reaction has been incredibly small. And I think it reflects just how quickly the administration was able to pivot. And I'll mention another thing. You sort of brought this up around the effective tariff rate. You think about our largest trading partners and what has changed. Japan negotiated themselves to a 15% tariff as part of the framework. Now, under the new regime, their tariff level ends up being at probably a 15% based on the new 122. Europe also negotiated themselves to a 15% tariff. They're under a 15% tariff under the new IEEPA regime. under the new 122 regime, and probably will be similar under the 301 regime later on after the 150 days expires. For China, changes on the fentanyl side, but at the same time, they had also negotiated themselves down to much lower tariff levels in the 10 to 15% range as well. US, Canada, Mexico, most goods there were excluded from all of this anyway because they are treated as tariff-free under USMCA. And so the effective tariff rate on both Canada and Mexico was actually quite a bit lower than implied by the outright numbers because of the USMCA treatment. Those exceptions are still in place. So you think about our largest trading partners, what has really changed on the tariff side with the 15% new minimum in place? And the answer is, I don't think that much. And so I think it really does justify a more modest reaction here in both FX markets and in rates markets. I think where this could potentially change is at the end of this process in late July. When the new 301 authorities come into place, the president could, in theory, decide to set tariff levels much higher or much lower than we have currently. So, say, for example, we're talking about in Canada and Mexico, we have USMCA renegotiation window opening up now kind of into July. Maybe he says, we're going to have higher tariffs than we did before as part of this new regime. That's certainly possible, but as we get to that point in the late summer, I'm sure the administration is going to be thinking very closely about midterm elections and the possibility of higher prices and potentially concerns around market volatility related to a rollout of significantly higher tariffs. We've already seen the administration show some sensitivity to markets when it comes to actual setting of tariffs. And so that'll probably be an important question that the administration is asking themselves when they're considering higher tariff levels at the end of the 122 regime in late July is, do we want to risk market uncertainty, higher volatility, and potentially higher prices that comes with meaningfully higher tariff rates this close to a midterm election? That decision would also potentially come at a time when the Federal Reserve is under new leadership, and they may be in the process of starting to reduce interest rates, and there might be some question over whether or not they want to throw a spanner in the works with additional tariff, significant new tariff upside. I do think the goal is going to be to make the regime at the end of this process look very similar to where it was at the beginning. But that is a point of potential interest, although maybe not one that markets can really focus on in the immediate term, given how much else is going on. So we've covered a ton of ground today. Ian, thanks so much for joining, and thanks to our listeners for listening. If you enjoyed this podcast, whether it be Bondcast or Currency Exchange, please consider giving it a like and also subscribing to our channel so that you can get the latest podcasts the moment they are released. Thank you so much.